Hello and welcome to our quarterly podcast discussing activities to support consistent application. And this podcast covers the second quarter of 2022, so it's April to June. I'm Patrina Buchanan, a member of the ISB's technical staff, and I'm here today with board member and chair of the Interpretations Committee, Bruce Mackenzie. Now, in today's podcast, we'll cover the discussions at the April and June Interpretation Committee meetings. And the committee covered a lot, so this is where we're going to focus our time today. Now, I also wanted to just briefly mention that the ISB made quite some progress in June on its narrow scope project on the classification of liabilities as current or non-current. And at that meeting, the ISB made decisions on almost all aspects of the project with the aim of finalising the amendments to IAS 1 before the end of 2022. Now, I promise that we will cover that project in more detail in the next podcast, the Q3 podcast, at which time we would expect all decisions to have been made. But if in the meantime this project is of particular interest to you, then I encourage you to go to our website, to the project page, and you can find out more. So let's get going on today's podcast then, and I'll start as ever with finalised agenda decisions. So in April, the committee decided to finalise the agenda decision on principal versus agent for a software reseller. And after being considered by the ISB in May, that agenda decision has actually now been published. So this agenda decision addresses an aspect of revenue recognition that can really be very tricky. Of course, it very much depends on the specific facts and circumstances. And of course, it really matters because the outcome of the assessment, determining whether you're a principal or an agent, can really make a big difference to the amount of revenue and expenses that an entity recognises. So the facts in this case were such that a software reseller has the right to sell standard software licenses, and those licenses are manufactured by a third-party software manufacturer. Now, the reseller is the party that arranges for the sale to the customer. They order the licenses on behalf of the customer. They provide advice to the customer on which licenses to order, and they set the price. However, once ordered, a contract is then created between the manufacturer and the customer, and the manufacturer, of course, has responsibility for the software's functionality. Now, the finalised agenda decision here really sets out the framework in IFRS 15 for assessing whether an entity is an agent or a principal, and it really walks through how an entity might think about and apply those requirements. And I really think here there's some very useful information in that agenda decision when making any principal or agent assessment, in fact, so beyond the fact pattern actually submitted and described in it. So that's all I was going to say in software resellers. That one we covered in more detail on a previous webcast. So let's move on to topics on which the committee voted to finalise agenda decisions, and there were 4 discussed at the June committee meeting. Regular listeners will know that agenda decisions are published only after the ISB is asked and does not object to their publication. So for all 4 of these topics, the ISB will discuss them either in July or September, and assuming that the board does not object, then these agenda decisions will then be published. So we've got IFRS 9, IFRS 17, IAS 32 and IAS 37 to talk about today. And I think we'll start with IAS 37. So Bruce, the question on IAS 37 asked about government measures to encourage the production or import of low carbon emission vehicles. Now, can you remind listeners of the fact pattern and what the committee decided?
Sure, thanks, Patrina. So in this fact pattern, regulations have been put in place to encourage entities to import and produce more energy efficient vehicles in a particular jurisdiction. Now, all importers and producers of passenger vehicles must sign up to this regulation. Now, entities receive negative credits if they import or produce vehicles whose emission levels exceed the targets set by government, and positive credits if they do the opposite. Now, the regulation requires an entity to eliminate its negative credits, either by purchasing positive credits or generating its own positive credits. Now, if an entity fails to eliminate its negative credits, the government can impose sanctions on that entity. Now, the submitter asked whether an entity that has generated negative credits has a present obligation that meets the definition in IAS 37 of a liability. And the committee said, yes. In this particular fact pattern, such an entity has a legal obligation that meets the definition of a liability if accepting the sanctions is not a realistic alternative to eliminating negative credits for that entity. Now, the agenda decision explains the committee's rationale in detail and, in fact, in response to comment letters, sets out the committee's conclusions in the form of a walkthrough of the requirements. So it explains the activities that give rise to the obligation. In this case, it's the import or production of vehicles with average emissions that exceed the government's target. It explains that both means of settling the obligation is an outflow of economic resources. Even if the entity decides to settle the obligation by generating its own positive credits in the future, those self-generated positive credits are economic resources that could otherwise have been sold to another entity. And it explains that the sanctions the government could impose are the enforcement mechanism to ensure entities settle their negative credit balances. If accepting the sanctions is a realistic alternative to settlement for the entity, then it would not recognize any liability. However, if not, then the entity has a legal obligation that meets the definition of a liability.
Now, Bruce, you touched on feedback and comment letters there, and I think this submission really is a good example of where the content and of agenda decision has really been very much improved as a result of feedback received in comment letters. So you sort of mentioned the improvements in the structure of the agenda decision as a result of that feedback. So now it's sort of structured more as a walkthrough of the different elements of the definition of a liability. And I'd also note the explanation now provided in the agenda decision that really links the committee's rationale for this fact pattern to the rationale included in IFRS 6 and IFRS 21, which are both of those interpretations include requirements dealing with the definition of a liability. So really here I just put in my ad break to say to you all, really keep sending us your comment letters, because the quality of our work, of the committee's work, will always improve if you engage with us. So I really encourage anyone listening with a particular interest in 37, by the way, to really read this agenda decision as well, because for me it really includes a lot of helpful material beyond, just for the fact pattern discussed, because of how it sort of walks through how to apply those different elements of the definition of liability. Moving on to our next topic. Bruce, I'm going to give you the easy task this time, because you're going to get that easy topic of cash transfers, because we all know how to account for cash, don't we?
Well, you are right, Patrina, that on paper, the question of cash transfers seems straightforward. Now, this question asks specifically about when to recognize cash received via electronic transfer as settlement for a trade receivable, when the transfer system takes 3 days to settle the cash transfers. So could the receiving entity derecognize the receivable and recognize cash on the date that the payer initiates the payment, or only when it actually receives the cash 3 days later? And this obviously matters only when the payment initiation and settlement straddle a reporting date. Now, IFRS 9 includes the applicable requirements and says that the entity derecognizes the trade receivable when its rights to the cash flows from the receivable expire, and recognizes the cash when it has the right to obtain the cash from its bank, so when the cash effectively is received. And I think most of us would agree that this sounds relatively straightforward and sensible. And indeed, almost all the respondents to the tentative agenda decision said they agreed, or at least didn't disagree, with the technical analysis. However, respondents also raised significant concerns about the potential implications of this conclusion on all payment methods, not only electronic transfer transactions that were described in the submission. They said that it could affect how entities have accounted for payments received via credit card or check, and also how entities account for payments made to settle trade payables. It could change long-standing practices such as performing bank recons, and could result in costs for entities who now have to go and investigate and potentially change their practices for payments received and made.
So how did the committee then deal with all these comments on the possible practical implications?
Well, by applying the due process, as we're required to. Now, the committee first considered the few disagreements with the technical analysis, and having considered those comments, all 14 committee members concluded with the technical analysis as set out in the tentative agenda decision. It then considered and noted the comments on the implications. In considering whether to finalize the agenda decision, the committee needs to assess whether it thinks the requirements in the standard provide an adequate basis for an entity to determine its required accounting. And in the case of cash transfers, it concluded that they did. The existing requirements do provide that adequate basis. Now, according to the due process requirements, committee members cannot consider the cost benefit of applying existing requirements, nor consider the outcome of applying those requirements, whether those requirements provide useful information. The board already considered those aspects when developing the standard. And because the agenda decision cannot add or change requirements in the standards, then it could be inappropriate for the committee to reassess what the board has already considered. Now, what the committee can do is report respondents' comments to the board. And in this case, given the strength of feeling in the responses we received, the committee decided to do just that. So they voted to finalise their agenda decision and also report respondents' comments on the potential wide implications to the board.
Thanks, Bruce. So this is really a tricky question for the committee to deal with. The committee received a question where the submitter had identified diversity in applying the requirements and for amounts that could be material for some entities. So the widespread criterion relating to submissions was met. And this means that in supporting consistent application, the committee must consider the submission and decide whether the requirements provide an adequate basis for an entity to determine the required accounting. I do think it's worth highlighting to listeners that on this topic and the next, on IFRS 17, the committee really had some really good discussions about sufficient time and the fact that if these agenda decisions are published and entities determine that they need to change their accounting, then the due process handbook sets out the trustees' and board's expectations that entities should be entitled to sufficient time to implement any change. And I think on these agenda decisions, more time may be needed to implement change than on other topics. So we already mentioned it, it's IFRS 17. So we're going to move there, and a topic actually that we discussed on the last podcast. It's about profit recognition relating to insurance coverage provided under a group of annuity contracts. Now, because we covered this topic in some detail on the last podcast, because of course we have a lot to cover today, then we're not going to talk about the technical aspects in detail here, but just really focus on some of the key messages from the committee's consideration of comments received. So just to make sure you know what we're talking about, I'll just give you a quick reminder of the fact pattern. This is a case where an insurer has issued a group of annuity contracts under which the policyholder pays a premium upfront to the insurer and then receives an even payment each year for as long as the policyholder lives. So let's say they get £100 per year for each year that they survive. So in this case, the policyholder is receiving insurance coverage for survival, and in the fact pattern considered by the committee, that's the only service being provided to the policyholder. So the question the committee was asked was about the recognition of profit, or in IFRS 17 words, it's about the recognition of the contractual service margin in profit or loss on that group of annuity contracts. So Bruce, what would you say are the key takeaways from the committee's discussion on this topic, sort of beyond the technical analysis?
So the first thing I'd like to say is that even when the standards don't include very prescriptive requirements, but include a principle, as was in this case, then entities still need to ensure that their accounting meets that principle. The second is specific to insurance contracts, but it's a general point to say that when the benefit of transferring the insurance risk to the insurer does not affect the recognition of the CSM in profit and loss. IFRS 17 deals with the insurer's release from insurance risk separately as part of the risk adjustment for non-financial risk. Finally, I'd like to say again on this topic that respondents raise concerns about the practical implication of insurers possibly having to change their accounting as a result of this agenda decision at a time when they're really busy with their IFRS 17 implementations. Now, as you mentioned, the committee discussed that fact that insurers are entitled to sufficient time to implement any change that might result from this agenda decision.
Great, thank you, Bruce. So the final, what I'll refer to as the finalised agenda decision discussed by the committee in June relates to special purpose acquisition companies, or SPACs. And in this case, the question was about whether particular shares issued by a SPAC could or should be classified as financial liabilities or equity, applying IAS 32. Now in this one, you may remember that the committee noted that this specific question asked really fits into a much broader topic that's actually currently being considered by the ISB as part of its FICE project. So in this case, the committee said, look, it's really best for the ISB to deal with that question as part of the FICE project. So that's all of those agenda decisions where the committee voted to finalise. In June, the committee also talked about a couple of new submissions. Now, the first new submission relates to IAS 29 and hyperinflation. And in this case, the question asked was whether in preparing consolidated financial statements, a hyperinflationary parent reporting in its hyperinflationary functional currency, does that parent restate the results and financial position of a non-hyperinflationary subsidiary to reflect inflation at the reporting date? So I suppose you need to picture a parent that's reporting in a hyperinflationary currency where it's got a subsidiary with a non-hyperinflationary currency. So in this case, the committee discussed the requirements in IAS 29 and in fact didn't reach a conclusion on whether the parent restates or does not restate the subsidiary's results and financial position. The requirements in IAS 29 could possibly be read in both ways. So in that case, the committee decided that it should actually obtain some more information about the situation and when it arises to help it decide whether to add a narrow scope standard setting project on the topic to the work plan. So we're going to talk about this one more in a later podcast when the committee actually comes back to discuss it again. And now moving on then to the final topic talked about by the committee, again a new question, which is one about insurance contracts and foreign currencies. So it's a question that involves the interaction of IFRS 17 and IAS 21. And in this case, the submitter asked two questions. The first is whether an insurer considers currency risk when identifying portfolios of insurance contracts. And the second is about how to measure a group of insurance contracts that generates cash flows in more than one currency. So if I start with the first question, which really relates to working out how to establish groups of insurance contracts. And why does that matter? Well, it matters because in IFRS 17, the unit of account for recognition and measurement purposes is groups of insurance contracts. So it's not the individual insurance contract, it's groups of insurance contracts. And the first step in establishing a group of insurance contracts is to identify portfolios of contracts. And IFRS 17 says that a portfolio comprises contracts subject to similar risks and managed together. So in this first question, the committee concluded that an entity is required to consider all risks, including currency risk, when identifying its portfolios of insurance contracts. However, similar does not mean identical. So it could be the case that an entity identifies portfolios that include contracts subject to different currency risks. Now, Bruce, I'm going to ask you to talk us through the second question. What does IFRS 17 and IAS 21 say about measuring a multi-currency group of insurance contracts?
So, Patrina, before getting into what the standard says, maybe it would be good to provide some background as to why this question has arisen. Well, first, it's because groups of insurance contracts often involve more than one currency. For example, you can have a single insurance contract with premiums in one currency and claims paid in another. And secondly, it's because there are no explicit requirements on how to deal with contracts that have cash flows in more than one currency. Now, the nature of this question is also similar to some we've had in the past, which is a question sometimes arise when a new standard must work together with an older standard. In this case, it's IFRS 17 insurance and IAS 21 on foreign exchange. So what do these standards say for multi-currency groups of insurance contracts? Now, the main requirement to mention is paragraph 30 of IFRS 17. Paragraph 30 states that when applying IAS 21, an entity treats a group of insurance contracts, including the contractual service margin, as a monetary item. So we know the contractual service margin, representing the unearned profit, could be viewed more as a non-monetary item than a monetary item. But for the purpose of applying IAS 21, the requirements are clear that the group of contracts, including the CSM, is treated as monetary. Now, this means that the entity needs to determine the currency or currencies in which the group, including the CSM, will be denominated. And why does it need to do that? Because if the group is denominated in a foreign currency, then IAS 21 requires the entity to retranslate the carrying amount at the end of each reporting period into its functional currency using the closing exchange rate. Now, what the tentative agenda decision then explains is that there are no explicit requirements on how to determine the currency denomination of a contract or transaction when multiple currencies are involved. So the entity would develop an accounting policy to determine the currency denomination of the group, including the CSM, considering the terms of the contracts in the group. The outcome would be a single currency denomination, or it could be multiple currencies reflecting the currencies of the cash flows.
So, Bruce, just to make sure I understand, so I think you're saying that the tentative agenda decision says an entity could either determine the group, including the CSM, to be denominated in a single currency, so perhaps the currency of the premiums or the predominant currency, or it could determine that the group, including the CSM, is denominated in multiple currencies. So I think you're saying an entity can choose. Is that right?
Well, sort of. Firstly, it's not a free choice. What the tentative agenda decision says is that the entity applies IAS 8, and having considered its specific circumstances and the terms of the contracts in the group, it develops an accounting policy that will result in information that is relevant and reliable as described in paragraph 10 of IAS 8. Also, the tentative agenda decision makes a couple of important points. It says, firstly, that an entity cannot simply deem that the CSM is denominated in its functional currency, because that would fail to treat the CSM as a monetary item. And secondly, irrespective of its policy for determining the currency denomination, the CSM for a group of insurance contracts is a single amount when assessing whether the group is onerous and when recognizing the amount of the CSM in profit and loss in each period.
Great, thank you, Bruce. So that tentative agenda decision is out for comment now, and it's out for comment until the 19th of August. So we look forward to hearing from you on it. So that's it. A whirlwind through the committee's discussions in April and June, and that now brings our podcast to a close. Thank you very much, Bruce, for joining me today, and thank you all for listening. Please email communications@ifrs.org if you have any suggestions for improvement. So thank you, take care, and goodbye.